Hello, everybody. I'm Michael Smith, and welcome to the Lowdown. And joining me today is my special guest, Kevin Lennox. Kevin, welcome to the show. Well, Kevin, I wanted to get things pretty kicked off here. The big headline that we're seeing this week and today is, CPI. CPI rose, and I think it rose more than what most expected. And there's kind of been a little bit of a mixed review today. I mean, the markets seem to shrugging it off now, but earlier today it did not. However, this is one of the big promises made by President Trump was, to the people, I want to, we all know sitting at the kitchen table, everything that we have at the kitchen table has gone up in price. Everyone that's gone out to eat knows things have gone up in price. This is something that he campaigned and said, I'm going to get inflation lower and get it back to stability. So what do you make of today's report? Is just something typical we see kind of in the seasonality, or is it something to be concerned about?
I think it was actually on our side of the street, Wall Street expected.
Okay.
We had $800 billion in deficit spending in the first quarter of 25.
Is that it?
Which is from October through December.
Yeah.
All of 24 was 2.4. So a lot of spending, which would have the expected impact of boosting the economy and also boosting inflation. So core CPI, which most people were watching closely, today came in 0.45% month over month, 3.3% year over year.
Okay.
But the 3-month annualized came in at 3.8.
Okay.
That's what we say the adults in the room look at the CPI report. We can vary month to month. 3-month trend is a little bit more meaningful. So inflation, as we've been talking about for months, maybe even over a year, is sticky and remains sticky, and probably will stay that way. We thought maybe because the spring of last year, January, February, March, had higher prints, hotter prints, CPI, we thought maybe the year-over-year comparison would make things just a little bit easier, and it hasn't to this point. We will see. But January is a month where companies can start to raise prices.
That's exactly right. So that's what you typically see. They kind of look at what the CPI report says, and then typically they set the price for the year. So that can be kind of misleading, or not misleading, but that can be kind of, I guess, dangerous for many people thinking, okay, well, prices are going to be raised for the rest of the year. Now, in the report, the one thing that stuck out, obviously, egg prices rose 15%, right? Obviously, something with the bird flu. See, these are things, but those are one-offs. Was there anything else in the report that maybe had you concerned, or that went up that may be a concern to you, or anything in there that might be out of the ordinary?
So shelter is still not dropping.
Yeah.
And there was disappointment that is still sticky and not dropping. The feeling is that it will, but people have been saying that for 6 months now.
Well, that's the one we've been hoping would drop, right? I mean, that's the one that's going to ultimately, because what is it, 30% of CPI? It's a high amount. Yeah. So that's the one we need to lag. Now, I guess, is there any specific reasons why it's not dropping, or is there anything that any color on that?
I don't have excess color on that. Rents have not dropped like they thought, or the more established rents have not dropped off.
Yeah.
Newer rents, which is a new Fed study that came out, those show current rates, lease rates rents have come down, but it has not tailored into the official data yet. But things have changed to where the Fed was expecting 4 rate cuts this year, and now it's down to 1. And Jay Powell was talking yesterday in front of the House, and he said that, and this is the first time I believe he has said this, the neutral rate, where you have economic growth without inflation, has moved up meaningfully over the past few years. He has said that the neutral rate was 2%.
Okay.
And with Fed funds now at 4.5%, there was room to move lower without sparking another uptick in inflation. So it's interesting that he said that. And just overall, the Fed seems more accepting of an inflation rate well above 2%. So there's a question now, could the next move in rates actually be a hike? Doubtful.
Well, yeah, very doubtful.
It would take a lot to get there.
Well, that brings me to why I think it's doubtful. Is kind of the next thing is we've got $9.2 trillion of U.S. debt that will mature or needs to be refinanced this year. I mean, $9.2 trillion. I didn't say billion. said trillion. And you think about that. I mean, it's kind of, think about anyone, why do I not want to move out of my house right now and get another house? If I got a house right now that's at 2.75%, and if I go buy a new place, it's going to be more expensive. We know that. And it's probably going to be double in terms of the interest rate, right? Well, now take that same concept. Isn't that what we have here? And I'd like to get your thoughts on that.
Yeah, so interest on the debt right now is $1 trillion. It exceeds defense. And when you've got $36 trillion in debt, 120% of GDP, the demarcation line is supposed to be at 100. But because we are who we are, the cleanest dirty shirt in the world, we're allowed a higher rate. But you could also throw in $200 trillion in unfunded liabilities. Yes. The strategy is either inflate the debt away, which means financial repression. Translation, you need an excuse to get the Fed funds rate below the rate of inflation.
And not politically popular, as we have seen.
Well, the other option is default.
Well, default,
which is last.
Yeah, which is, well, that's definitely last.
So now Scott Bessent, the new Treasury Secretary, very much in a political type of position, has talked about ways we can adjust the asset side of the balance sheet rather than simply addressing the elephant in the room, which is the liability side. So the Fed is looking for any excuse to be able to cut rates, and they didn't get it today.
Well, Kevin, the other one is devalue. And that's one thing I've not, and I thought by now you would at least hear Trump or Bessent or somebody address the dollar, but no one's touched that yet. Is there any thoughts on that, or what are your thoughts on the dollar and where that's heading?
So there are two camps on the U.S. dollar. Vice President Vance is very much on the weaker dollar side. And then you've got others in the administration that want the strong dollar as the symbol of strength. Trump seems to vacillate in between. So I don't think we really want to devalue the dollar per se. So I think they're willing to show patience and just see how this plays out and just hope that inflation starts to come down slowly on its own.
Well, let's not forget, he just got inaugurated. I mean, I think we're not even a month or barely a month in. So, it's quite a bit's been done, as we know. But, I mean, we can't expect for all of it to be solved yet. But, I mean, I do agree, probably sitting and waiting, at least with this earlier being, waiting to see what happens before they have any big response. So, Kevin, I wanted to turn our attention to something I heard recently. I'd like to get your take on this. So, Treasury Secretary Bessent talking about revaluing gold. And, when you hear that, for me, that goes back to, gold has been revalued twice in the United States. Back in 1934, the Confiscation Act. And then, of course, we saw the gold window close with Nixon in 73, I believe. So that's what my mind goes to. Are we talking about the same thing here, or what is he talking about doing? And then what is the impact of that?
So he's trying to be creative here and addressing the asset side of the balance sheet.
Okay.
And current gold held at the Treasury is marked at $42 an ounce. So it's currently $2,800.
I was going to say,
an ounce.
I'd like to buy it at 42.
Like, why can't we mark that to market? And then creatively, we could shift that to the Fed as an asset. They could repo, complicated way of saying, for that transfer, send 800, call it maybe 780 billion net to the Treasury, which would go to the Treasury general account, which is basically Washington's checkbook.
Gotcha.
So therefore, then they could support 800 billion, almost 800 billion.
So that's where the spending can come from.
Spending and limit the issuance, to your point earlier about 9 trillion. So it doesn't amount to a whole lot percentage-wise, but it shows the creativity that they're trying to use here. And another thing they've talked about for months was loosening regulation, loosening the leverage ratio on banks. Things got very, very tight after 2008.
Banks didn't want to lend.
And now, and capital requirements were tightened severely. So now they're looking at it again and going, perhaps it's a little too tight at this point. So if they loosen the leverage ratio, then banks have the ability to hold more treasuries. And at the 10-year and the 20-year, 30-year treasuries, those auctions have been an adventure based on how many foreign buyers show up. They bought the short-term paper pretty reliable.
Sure.
They've not been showing up reliably to buy the longer-term paper.
Well, and this has been the big issues. I mean, our issuance, the foreign buyers have dropped. The pensions used to be the big buyers of that. That's all. We obviously know where pensions are heading. And of course, it's kind of the same thing Japan did. They had to come up with creative ways to move the balance sheet around to create, that excess for funding. Sounds like we're moving by the way of Japan. Now, the only thing that gives me at least some comfort in this is hearing what Doge is doing as we're making some, and we talked about this last time. I mentioned, the wall of debt coming through, and all this debt that needs to be refinanced. They're going to have to be creative. So it sounds like that's what they're doing. But at the same time, if they're being creative and they're going through and finding waste, that actually gives me a lot of comfort. I mean, if they're just being on the creative side, that's just something now. They're going to have to figure out something later. We're just kicking the can down the road. But if they're going in and actually finding where money's being spent or misused or fraud, whatever you want to call it, that gives me a lot of comfort in that regard.
Yeah, there were expectations that Doge was probably overhyped.
Yeah.
The amount of savings would probably be pretty modest.
Yeah.
But it looks like it could be a much bigger number than expected.
I mean, it's $1 billion a day so far, right? That's pretty impressive. I mean, if that's
pretty soon it starts adding up to real money.
It sure does. It sure does. And I mean, this could be amazing. I mean, I think this is the Malaya effect, but I think it's going to be the most transformative disruption to government we've ever seen. And I love it.
I would agree with that. And you mentioned the issuance before. And going back to Scott Bessent, he had been critical of Janet Yellen's shift, favoring T-bill issuance, short-term treasuries, to finance the government rather than a more even distribution, through the maturities, particularly the 10-year, 20-year, and 30-year. He thought that was gaming the system by Yellen.
Okay.
Turns out he's now decided, well, that was probably a pretty smart idea, and he's going to continue it.
Didn't you tell me something offline that perhaps they're suggesting Japan buy our 100-year treasuries? I mean,
that's another one of the creative elements.
Okay, all right. I was going to say they're getting very creative here.
You're part of NATO. We protect you. We've allowed you to weaken your currency more than others, and we haven't said anything. Now we have an issue with long-term treasury. We need buyers. We would like you to, and this is just a thought right now in Washington, is to force basically Japan and other allies potentially to buy, for example, 50 or 100-year treasury bonds, maybe even zero coupon, which means you don't pay them anything. For that
what a deal.
Protection. So, it goes back to, Bessent. He said contradictory, things, are tariffs inflation or are they not? We'll get into that. But they're really trying to be creative. And for the first time, really since mid-2000s, they've got Wall Street people in the Treasury Department and other areas of Washington now that have sat in a risk-taking seat and can come up with creative ways to deal with the current financial situation.
So what does that mean for markets? I mean, one of the biggest things we've talked about, Kevin, is liquidity is the number one thing markets need, right? Uncertainty we certainly have right now, but I think I would welcome this uncertainty probably more than any I've seen. This is uncertainty because we're cleaning things up, right? Mm-hmm. I think I'm a lot more comfortable than maybe some geopolitical, which we have those tensions, but this is a different type of uncertainty. It ultimately will hopefully settle out, right? Mm-hmm. But liquidity means positive things for the stock market. Absolutely. And so what you're talking about, this issuance, being creative, all these things, if I'm listening to this, well, what does that mean? Well, it's positive for the markets, right?
It can mean more liquidity in the treasury markets and lower yields. Yeah. They are actively trying to find ways to create a lower interest rate environment, which then spurs borrowing and investing and all of that.
And but despite the $9.2 trillion that we need to refinance, how many people? Again, housing has been dead, right? Housing is completely stuck. Unless you are transporting from another city to another city, there's not really any other buyers. No one's buying up. The millennials and Gen X are still kind of figuring out if they want to go buy another home. So that's been stuck. But if the rates do come down, that does spur the housing market, which is typically the biggest asset most people have. And that's a good reflection of balance sheet. That does give those animal spirits and kind of leads to more positive outlook for the market. So a lot of things kind of point to, this. We were talking about this, like, I guess before the end of the year, whether we're going to have a soft landing or hard landing. Where do we stand now?
Maybe no landing.
No landing.
Which is the sticky inflation. And, GDP stays 2.5-ish percent. Inflation is higher than where we want it to be, but it's not runaway inflation. We don't see that. Wage growth, I think, came in at 3.4% over the past year. The disappointment really was in productivity.
Okay.
Which we thought, when are we going to see
the AI?
AI. Productivity was 1.2 in the fourth quarter.
Yeah.
That's not where we want it to be yet. So there will.
There's got to be a good lag effect on that, but I think it'll come.
There is.
Yeah.
There is. It's more in the development stage rather than the actual execution value added.
Exactly.
To this point, but S&P 500s have surprised to the upside. I think earnings are up 14%.
Okay.
So far for the fourth quarter. Margins 12.5% above the 5-year average of 11.5%. So corporate America is doing well. Financial conditions that I always look at as far as a forward look at the economy and business conditions, I don't see any negative issues there. So a lot of headline risk now, a lot of noise, but the stock market, S&P 500 has been pretty much in a tight range.
Yes.
For the last few months, almost 3 months.
Yeah, it's kind of a sideways, I would call it.
And it almost looks like a distribution phase.
Okay.
I will say this, retail has been very heavy buyers. They, in fact, JP Morgan has a retail sentiment index, which set a record for bullishness, which even exceeded the meme mania days of GameStop. So everyone is in the pool.
Yes.
But so far the fundamentals look actually pretty good.
Well, just remember the rubber band can be stretched a little bit further, right?
Sure.
And especially with some of the things we see in the United States. Now, I'm going to ask you about this because this is the one thing that this could be the cog in the wheel, and tariffs, right? We all know about tariffs. We've heard about tariffs. I mean, if you can't, unless you've been in a hole the last month, you definitely know what tariffs are. But talk to me a little bit about what are we seeing? What are your thoughts on that? You hear tariffs can be inflationary. Typically, tariffs are probably short term. I think in Trump's administration, they're used to be to get to the negotiating table. But what are your thoughts, and maybe elaborate some more on that?
Yeah, I think by and large, Trump really wants to have a strong economy and strong markets, and but he will use tariffs and whatever he can as leverage to get a better negotiating deal.
Yeah.
To put the U.S. on top. And he's willing to accept some headline risk, all the volatility, some lack of CEO confidence from just our heads spinning from day-to-day headlines. But all in all, I think the tariffs will not prove to have a huge impact on the economy. It'll be more headline than actual impact. We'll see, but some tariffs can be inflationary, more inflationary than others. So I would say in general that tariffs, unless they're supported by the additional capacity to spend, then you're taking demand from elsewhere in the economy.
Okay.
So unless money is being printed, government is spending more and more deficit, there's more and more deficit spending, then tariffs probably aren't going to be meaningfully inflationary.
Well, I agree. I think tariffs are there as noise right now. I agree with you as far as negotiation tactics, so I wouldn't get too caught up in that now. Anything can change. Obviously, we know that, but definitely something we'll keep everybody posted on. So, Kevin, I want to cover a few more things. One, we heard about DeepSeek. This is the ChatGPT competition. You had a great explanation offline. I think that is very helpful. As many people are trying to get their arms around AI is very complicated. But what exactly does that mean? You used a good analogy earlier. I thought I'd throw that to you, and you could tell to our listeners and explain the same thing you told me.
Sure. So we've heard about how power hungry all these AI processes
GPUs, yes.
GDP. And if Google were to take on the same type of capability as ChatGPT, it would require 10 times more energy.
Yes.
So these data centers are being built all over the country.
Sucking up energy. We need more energy,
and then
right?
we're going to need nuclear to supplant that. And so it's like if you're doing AI, even a limited function in the U.S., well, then you have to turn on every light in the house to run this limited function. And China came out with a very practical and efficient way saying, well, if you have a limited function, why don't we just do this one room? That's all we need.
Yeah.
So all of a sudden now
a fraction of the energy compared to what we've seen here.
And so, the opportunity for disruption within AI and among these hyperscalers has really gone up now.
Yes.
Because that was a shot from the dark.
Yeah.
And there will be more of that. And so there's like 310 billion in CapEx from these hyperscalers. So the Amazon, the Google, Meta, Microsoft, 310 billion.
Wow.
It's multiple times higher than it was just a few years ago. So we went from, those four very, cash cow type companies to now all of a sudden they're very capital intensive businesses where the return on invested capital has become a lot less visible. So unless they really start to monetize that and we see earnings upgrades for these hyperscalers to match, to offset the CapEx gains, then you could start to see the Magnificent Seven start to trail in market performance. You're already seeing dispersion among the seven, led by Microsoft at this point to the downside. That could continue, and that has market repercussions if we have this rotation. And if we keep sticky inflation, then that makes a case then for more of a rotation toward value, which we haven't talked about for a while.
Well, that's a perfect example. I mean, we're one of the most innovative cycles we've ever seen in the history of mankind, and things are happening a lot faster. Again, when weeks seem like decades have happened, right? But that is how quickly a narrative can change. Now, the last thing I want to ask you about is, with all this being said, everything we've talked about today, how should people be positioned in their portfolios, and is there anything they should be considering or be patient, or what are some advice there?
Bottom line advice is be patient here.
Okay.
That the headlines have our heads spinning every day. And I think it's it's a situation where it would be very easy to make a mistake.
Correct.
So we have had diversified portfolios. We've focused on quality on the stock side. I still think that makes a lot of sense. And then on the bond side, we've been shorter than benchmark maturities, and I still think that makes a lot of sense as well. The bigger risk, I would say, on the fixed income side is going to be with more the private credit, the leveraged loans, where they really need lower rates. And if rates are going to stay higher for longer, then the less creditworthy participants are going to start to feel the headwinds from that.
Well, so it sounds like patience. And then I guess one thing I would add is, just with all these headline shocks, allow yourself to be patient but opportunistic. When things get hit, that there's overreacted. I think this is a great opportunity for to be patient and be opportunistic. So I'll leave it there, and we'll be on next month, and I'm sure we're going to have a whole pile of things to go through. So it's definitely exciting times, and to me it's exciting. So anyways, well, thank you for listening to Lowdown, and we'll talk to you next month.